Hello everyone, this is Tejas from Trendline and we'll be looking at banks that outperform their industry in terms of net profit growth and revenue growth year on year in Q2 FY23. According to Trendline's forecasted estimates, these banks are expected to see revenue growth in Q3 as well. Another factor that set these banks apart from the pack is how they are trading in the PE buy zone. This means that the TTM PE ratios are lower than their historical averages. Four banks made it to this shortlist. The stocks are Axis Bank, Bank of Baroda, Canara Bank, and IDFCFirst Bank. Among these, Bank of Baroda and Canara Bank are from the public sector, while the other two banks are private banks. The Indian benchmark index Nifty 50 has been on an uptrend for the past 6 months after it touched a 52-week low of 15,183 in mid-June. But the banking industry is faring even better, with the Nifty PSU Bank hitting a 52-week high and the Nifty Bank rising to a life high in the last month. Investors are flocking to public sector bank stocks in particular, and in the past 6 months, Nifty PSU Bank Index rose a staggering 55%. Investors are positive about the industry due to rising loan growth and improving asset quality. Management in the sector outlined a bright outlook for the banks during Q2 earnings calls. Uday Kotak, CEO of Kotak Mahindra Bank, said we were in one of the most amazingly benign credit cycles he had seen for a long time. He added that significant loan book growth in commercial vehicles, unsecured retail, microfinance, and micro and small and medium enterprises or MSME will enable a strong overall loan growth going forward. Let's start by comparing two PSU banks, Bank of Baroda and Canara Bank. Among the public sector banks, Bank of Baroda and Canara Bank are trading in the buy zone and posted industry-beating net profit growth in Q2 FY23. As per Trendline stock comparison tool, competition is fierce between these two banks, but Bank of Baroda manages to outperform Canara Bank in 24 out of 44 parameters across fundamentals, technicals, and shareholding. Let's take a look at some of these metrics. Both banks have been posting strong revenue growth since Q4 FY22. Healthy loan growth and rising other income, mainly in fee and treasury income, are driving the top line higher. Bank of Baroda's revenues rose over 27% in Q2, while Canara Bank's revenue increased by 18%. Strong retail loan growth was a key factor for revenue rise in both the banks. Canara Bank's management believes that the overall loan growth will continue in the next 2 quarters and guided that it is likely to be in the double digits in FY23, which is higher than the earlier guidance of 8%. Corporate, retail, agriculture, and MSME are major sectors in the loan mix. Retail loans drove the loan book growth for Bank of Baroda, while corporate loans helped Canara Bank in Q2 FY23. For Bank of Baroda, the personal loan portfolio was the star segment, which jumped 2.7 times in Q2. Its management said growth in this segment could moderate going forward as it believes personal loans grew at a strong pace due to pent-up demand. Management expects the corporate segment to propel growth in H2 FY23. Meanwhile, Canara Bank's corporate and agricultural loans grew at a faster clip compared to other segments. MSME advances, which grew 10% year-on-year in Q2, had the highest gross non-performing asset ratio of over 10%. Corporate and agricultural loans have GNPA of 8% and 4.2% respectively. Speaking of NPAs, the net NPA ratio of these banks are on a sharp downtrend, indicating improving asset quality. NPA deducts the provisions made by the bank from gross NPA, giving the value of non-performing assets after the bank has made specific provisions for it. GNPAs fell for both banks, driven by stronger recoveries resulting in lower provisions, which in turn led to lower net NPA ratios. Improving asset quality leads to lower provisions, and this helps the company's net interest margin to rise. In addition, delay in passing of interest rate hikes to customers and raising loan interest helps boost the margins. Bank of Baroda's management guided a 10 BPS improvement in FY23 over FY22, and Canara Bank's management said it is confident of achieving its guided 2.9% NIM in FY23. Despite a recent run-up in both these banks' share prices, they are trading in the PE buy zone, and the TTM PE ratio is lower than the industry average of 19. This means the TTM PE ratios of these banks are lower compared to the historical averages and their industry. In addition, both these banks are strong performers according to Trendline's DVM classification. Strong performers are companies with high DVM scores, rating above 50 to 55 across durability, valuation, and momentum metrics. This is reflected in the analyst consensus recommendation as well. which represents a buy rating for both banks. Analysts expect the growth momentum to continue on the back of strong interest income amid improving asset quality and rising margins. However, rising interest rates could hurt the loan growth in the coming quarters. This is particularly important for the personal and commercial loan segment, which could see lower demand with rising interest rates. Let's now move on to a private bank in the large cap space. Axis Bank made it to the list as it is trading in the PE buy zone with high expected revenue growth year on year in the next quarter. It beat the banking industry in both revenue and net profit growth year on year in Q2. With a strong growth outlook, the analyst consensus recommendation for the bank is buy. Axis Bank's quarterly revenue has been on the rise year on year for 7 consecutive quarters. Q2 revenue rise was driven by strong fee income growth, rising NIM and improving asset quality. Net interest income grew 31% year on year and 10.4% QOQ. However, the total deposit contracted by 1.3% in H1 FY23. It is worth noting that the current account deposits remained flat in Q2, while retail term deposits were also flat for the past 7 quarters. Despite this, Axis Bank is expected to post a 21.3% revenue growth in Q3, according to Trendline's forecaster estimates. Axis Bank's advances grew 14% year on year in Q2, mainly led by strong growth in retail and SME sectors. Home loans and rural loans, which make up nearly 50% of the retail loan book, rose sharply amid increasing demand. But the corporate loan books grew at a relatively slower rate, and the management said the focus will be on the mid-corporate segment, which grew 49% year on year. Axis Bank's net interest income rose mainly due to better loan yields that are dependent on higher repo link pool and increased retail share, which also has higher yields. Management expects NIM to be maintained at the current 4%, driven by a shift in loan mix towards the retail segment. However, it added that passing interest rate hikes to deposit could lead to a jump in the cost of deposits. Net NPA ratio fell sharply in Q2 FY23 and has been falling consistently since Q1 FY22, indicating improving asset quality. Corporate loans has the highest GNPA ratio of 4.2%, while retail and SME loans GNPA was below 1.2%. Falling net NPA is helping the bank boost margins and net income. Let's move on to the final bank in the mid to large cap space that is trading in the PE buy zone and whose revenue is also expected to rise in Q3, IDFC First Bank. Like many banks, IDFC First Bank's revenue also grew at a healthy rate in Q2 FY23. The bank managed to beat the average industry revenue and net profit growth comfortably. IDFC First net profit jumped over 5 times year on year in Q2, led by a significant improvement in all key metrics across such as higher NII, robust retail deposit growth, and lower cost ratios. The bank's loan book grew 32% year on year, and it was mainly driven by strong demand in the retail loan segment. The management has guided a 25% loan book growth in FY23. A sharp rise of 42% year on year in the retail segment was supported by housing and vehicle finance. A report from Motilal Oswal says that the bank is entering a phase of strong loan growth as the drag from the wholesale book, which has higher NPA ratios compared to the retail book, moderates. The brokerage expects the profitability to rise, aided by the replacement of high-cost borrowings and better cost trends. The bank's management said it has been replacing concentrated infrastructure-oriented project exposure with a well-diversified mid-tier corporate exposure. IDFC First net interest margin rose 20 bps to 6% in Q2, aided by lower credit costs and falling provisions. The CASA ratio also improved in Q2, leading to higher NIMs. The bank is confident of maintaining the margins at this level as it seeks to utilize the benefits of lower cost of funds by migrating to safer customer segments. CASA ratio is the ratio of deposits in current and saving account to total deposits. The higher the CASA ratio, the better. The higher percentage indicates lower cost of funds because banks do not usually give any interest on current account deposits, and the interest on savings account is usually very low. With the bank shifting away from segments with higher NPAs, the net NPA ratio is on a sharp downtrend. The management said the quality of customers continued to improve as those with a credit score greater than 700 have increased to 83% of new bookings in Q2 from 61% in 2019. With improving asset quality and strong loan growth, IDFC First Bank's revenue is expected to rise nearly 25% year on year in Q3 FY23. So these were the 4 banks with a positive outlook and are trading in the PE buy zone. However, investors will have to consider the rising interest rate and its impact on loan growth. This will be particularly important if inflation continues to remain at elevated levels, prompting the RBI to continue raising interest rates. You can find more information on these banks and any listed company on trendline.com. This is Tejas signing off.